All right, let's keep it going with the energy markets. And the global oil market is reeling from one of the largest supply shocks in modern history. Since the Iran-linked conflict began nearly 50 days ago, over 500 million barrels of crude and condensate have been knocked out of the market. That's according to Kepler data. At prices of around $100 a barrel, that translates into more than $50 billion in lost revenues. To put the scale into perspective, the supply loss is equivalent to 5 days of total global oil demand, nearly a month of oil consumption in the United States, or over a month of Europe's oil needs. Analysts say the disruption is unprecedented in scale, with ripple effects already visible across energy markets worldwide. The crisis has sharply disrupted production and exports across key Gulf producers. In March alone, output from Gulf Arab nations fell by nearly 8 million barrels per day. That's close to the combined production of two global oil giants. Jet fuel exports from the region have also collapsed, dropping from nearly 20 million barrels in February to just over 4 million barrels across March and April combined. The lost supply has triggered a significant drawdown in global inventories, which have fallen by about 45 million barrels so far in April. Meanwhile, production outages have surged to nearly 12 million barrels per day, tightening supply and keeping crude prices elevated. While a ceasefire agreement has led to the reopening of the Strait of Hormuz, uncertainty continues to cloud the recovery outlook. Iran's foreign minister has signaled stability in the waterway, and U.S. President Donald Trump has also indicated that a broader deal could come soon. But timelines remain unclear. Even with easing tensions, restoring supply will take time. The heavier crude fields in Kuwait and Iraq may need up to 5 months to return to normal, while damage to refining infrastructure and LNG facilities could take years to fully repair. Analysts warn that the aftershocks of this disruption will be long-lasting.